was too many sellers. We already identified there was a high probability that they would come back up and trade this level. And we were right. You see it? Too many sellers, high probability trade level, and a trade outcome. So if you can start recognizing that, you can start dealing it. I'm not saying you're going to buy this candle, because this candle technically is a fair value candle. What we're saying is, if this candle gets flipped, or even if this candle gets flipped, there's a very high probability starting to be attached to the buy side of this marketplace, because those sellers are now offside. So your buy trade would actually be there unless you got an absorption print on either of these two red candles. You can use that order flow to now allow you to get into that accelerated move. And because there's so many sellers in here, you can see it from this zoomed out chart, there's so many sellers in here that it makes it perfectly obvious that if you're right about your order flow, remember the conversation we had yesterday. The conversation that was taking place in this area was about people competing for that sell order. If nobody's competing for the sell order, the price continues to go. Yes? That's called fair value trading. If there's a real money competition for those sell orders, there's a reason for it. So if there's a lot of sell orders in here, there's a lot of people competing, whether you agree with it or whether you disagree with it is irrelevant at this stage, because you're at a bottom edge. The relevance is that they are competing for that sell order. And if they're competing for that sell order, you are able to answer that by simply drawing a straight line across your chart and highlighting the competition. We called this before this happened. You might remember. We actually called this buy trade before the price rallied through that phase. We said that this selling looks as if it's oversold and it's likely to retest the highs for the US Open here. It has now retested the highs for the US Open. The price has gone back up and the bond has continued its beautifulness, which was, of course, what we called the inflation break-even trade. A sensational bit of business for people trading on treasuries. We started to recognize that there was value on the short sell off the 28s, and the price has rolled beautifully back to the downside. Does that mean there's going to be value to buy at the cash open? Very high probability at the moment. Cash open still in 18 minutes time. So we've got the two elements that lined up beautifully there. We got the inflation break-even story. We got the sell on bonds. We got the sell on oil initially, but we recognized the competition for the auction. And we were able to either scratch the oil or close out the oil for a profit. These are the two trades here. There was the inflation break-even sell on oil. There was the bond component of that inflation break-even. The bond component of that inflation break-even is still making lots and lots of money. You can see there was another opportunity to sell your inflation break-evens part of oil. And obviously you go back into your oil at that stage and recognize the 89.50s wholesale and say, well, let's see if we can get a little trap up here. Let's see if we can get somebody trapped up here because you're short bonds anyway. In other words, you're putting another inflation hedge into place at this stage here, aren't you? So you start looking at your oil. You start looking for the deltas overtaking the price. Not crystal clear, but it definitely starts to happen, doesn't it? We started to see a slowdown on the tick and a little acceleration on the deltas here. I still don't see the right candle because the buy rates, the candle should have appeared up here, but the tick actually accelerated. So that kind of took me away from that second short sell into the top edges, or in this case, third sell into the top edges. It took me off of that as a possible sell. So quite happy to now wait to see if the deltas start to agree, and the deltas are starting to finally line up with that bit of business now, aren't they? So we're possibly going to get another sell. We've obviously got the sweep price. We've got a wholesale price on the deck contract, which is 88 evens. So obviously a little sweep of that would give us a nice opportunity. They are trying to pump it just now from the book. So the book liquidity is a pump and dump top line sell. So that's something we're watching at the moment. I can see these green blocks suggesting that there are still some buyers trying to cause that to happen. But they're obviously struggling a little bit, and obviously it's just rolled out of that area when it went south against this block here. You can obviously see that that's caused that little roll away from that price for the time being. So cheeky little opportunity, I think, at the moment. I think it looks good. That inflation hedge looked very, very powerful. Sell side bonds, sell side oil. And that gives us a very high probability trade outcome because it has that built-in trading loop. If you're wrong, you won't make any money. You won't lose any money. If you're right, you make money. Is that not a good? Payoff? If you're wrong, you break even, and if you're right, you make money. I like that kind of payoff, guys. I like that as an idea. I like that as a concept. It's like Kim buying a lottery ticket. Imagine they said to Kim going into the lottery, you can have as many contracts as you want. You can have as many tickets as you want, as many tickets as you can afford. And what happens is once the lottery's been made, if you don't win any money on the lottery, you can bring your tickets back and we'll give you your money back. It's a pretty good deal, right? So either you win on the lottery, whether it's $8 or whether it's $8 million or whether it's 8 billion according to the American lottery at times. So you either win the lottery or you get your money back. Well, the inflation hedge trade has that type of quality about it. Either the inflation hedge trade works or you break even on the rotation. If it works, it's because the oil price had been manipulated. If it doesn't work, it's because oil prices is correct and therefore bonds will make money. One or other is going to be right. It's got to be one or other of those two outcomes. There is unlikely to be any other scenario at this point. Whether it happens in the future, it doesn't make any difference. At this point, it's unlikely to be any other scenario. So therefore, if we're right, and it was an oil manipulation, we should be able to make money on the short oil, and we should be able to make money on the short bond. If it wasn't, and we're wrong, the oil price keeps going higher, the bond keeps going lower because of inflation, and we make a break-even spread. Does that make sense to everybody according to this inflation hedge narrative? Is that not how incredibly impressive this type of trade is? It's brutally brilliant. How many people trade the inflation hedge? If it's that brilliant, how many people trade it? Nobody, right? So in other words, a lot of people see how brilliant the pound trade is and nobody trades it. A lot of people see how brilliant the inflation hedge trade is, but nobody trades it. Why? Seems a little bit too much like hard work, doesn't it? Putting 2 contracts on instead of 1. I mean, it's a lot of hard work. A lot of hard work. Or alternatively, just bone lazy. Too bloody lazy to bother your backside to make some easy money, right? Still sellers coming in. Next rotation due up again. So next rotation due up with the number of sellers coming in. There's a competition for those sell orders at the moment. And, I still like the sell. So I'd like it to go back up a little bit so that I can get that top line short. I'd like to get that top line short back in again and try it all over again. But there's an awful lot of sellers across the oil at the moment. Sorry, an awful lot of buyers absorbing a lot of sell orders at the moment. So it's going to be interesting to see which player comes out on top in this little phase here. But I think the inflation break-evens looks really good for the short. So we've got the short bond on. We've got the short bond on. There was another opportunity to sell the oil there. That was this one here. So obviously all you had to do was try and figure it out and find it. And then you've got your short bond that's now making some nice monies. Obviously, you watch for the other inflation break-even starting to agree with the oil. If they do agree with the oil, then of course one of them started to agree here with this oil here. So on that basis, you start using that as your exercise to get away from your bond position at that stage and start booking into some of that little bottom edge there. And there's that rotation that we thought was going to happen. It took a little bit longer. Still never got an absorption to lean against for that rotation, but you can see what happened. Too short, isn't it? Way too short at the moment. Whether you're bearish oil or not, it's still way too short, right? And because it's way too short, the market makers are now in a very short problem. They can't afford to take this price down, can they? They can't afford to take the price down. And therefore, they're better incentivized at the moment to take it back up into these key areas. That's the whole point. That's why I said I'd far rather if they took it up a little bit here to give us another opportunity to get that better price. Lovely, isn't it?